Welcome to Financial Insider Weekly. I'm your host, Michael Gray, CPA. My guest today is Don Pollard, and Don is a Chartered Life Underwriter, which we also call a CLU, and a Chartered Financial Consultant, which we use CHFC. And he's an insurance broker at Advanced Professionals, which is a regional insurance brokerage company headquartered in Northern California, serving about 350 clients. The company offers employee benefits and executive life and disability insurance planning. Don has worked in the insurance industry since 1973, and he's been at Advanced Professionals for 12 years. He's managed insurance agencies and trained agents, and he's currently the incoming president for the Silicon Valley chapter of the National Association of Insurance and Financial Advisors. Today, Don and I will be discussing the Healthcare Reform Act, and what that means for us as U.S. residents. Now, actually, we're going to be talking about it more specifically as it relates to employers today. Now, our purpose is to give some basic facts about the new Federal Healthcare Reform Act to promote better understanding about what it means for us, because there are a lot of people that are very confused about what this is about, so we're having a lot of controversy about it. As we get started, though, I want to give you a caution. This is a huge piece of legislation. We can't cover all of the details, and regulations will be developed under the Act. It's going to fill in a lot of the holes, but what that means is there's a lot of unknowns. There's a lot of things that we just don't know about. But we're going to try to give you some basic information today so that you'll be a little more comfortable about what's happened here. All right, Don, let's get started. Why was it necessary to pass healthcare reform legislation? What problems is this addressing?
Well, I was thinking there as you were giving my introduction, and thank you for that introduction, that when I started in the insurance business, the medical insurance premium for an employee, 35 years old, was about $40 a month.
Yeah.
And now, of
good
course,
old days.
the good old days. And now, of course, we're way out of bounds on that. And that, I think, is a portion of the problems that we face. A large portion of it is related to the cost. Mm-hmm. And a piece of it, which is sad, is the cost that we're actually paying versus what we're getting. And to give you an example, we pay roughly 16% of our GDP here on healthcare and / medical insurance, and that's roughly 2 times the median of all the other industrialized nations. So we're paying them a 2x, and we rank 15th of 19 in mortality from conditions that are amenable to insurance. Mm-hmm. And we also rank last in infant mortality out of 23 countries.
That's really shameful.
And we are tied for last on healthy life expectancies beginning at age 60. So clearly we're paying a tidy sum and not getting probably enough out of it as we should. Over the past 10 years, Mike, premiums have increased 131%, while wages have only increased 38%, and inflation at 28%. So you can see we're 3 to 4 times the rate for increases in the premiums, and that is a major problem. Another factor of that is uncompensated care, which is people who go to the emergency rooms for their care. They don't have insurance. Those expenses are then taken in by the states, and that's causing clearly problems that we can't afford to have in California. And then, obviously the biggest of them all is the number of Americans that don't have insurance for one reason or another. So the Act addresses those, I think, in a favorable way.
Good, okay. So what are some key components of this Act?
Well, the Act has, I think, basically 5 components. We talk about the individual mandates, you have employer mandates, you have coverage mandates, the implementation of insurance exchanges, And also we have, of course, the revenue generating portions of the Act.
Okay. So what are some key provisions for employers in particular, and when will they be effective? Now, as we get into this, I want to remind people that this act was enacted on March 23rd, 2010. So this is like our benchmark that we sort of move out from.
Right. So we take our first thing relative to employers out at 3 months. That'd be June 23rd, and that is the temporary retiree reinsurance program. And what that is a reinsurance fund set up for employers who provide retiree insurance for their former workers between age 50, but that haven't reached the age for Medicare yet. And what it does is it reimburses the employer 80% of their claims between $15,000 and $90,000. So that's going to be a big boon for our larger employers. 6 months, we have the big four, I'll call it, where we have dependent coverage for adult dependents up to age 26, which is now going to be law. No pre-existing condition exclusion for children under age 19, and no rescission of policies by insurance companies except for fraud, and then no lifetime limits on coverage amounts. Now there are restricted annual limits that are left in for some particular areas of coverage.
Okay.
Now we hit up to 2010, the rest of the year, where we get the small employer tax credits that kick in, and this is designed for employers out of less than 25 employees with average wages annually of $50,000 or less. The employer is required to pay at least 50% of the premium for either the elected plan or the baseline plan of the employee, and the employer is eligible to receive a tax credit of 35% of the employer's portion of the premium paid.
Now, before we move ahead,
sure,
I just want to remind people, we're talking about right now. So
this is this year.
Yeah, 2010 is now. So in case
Exactly.
it's zoned out, you know, it's that, oh,
Right.
well, this is someday. This is now. So employers need to be aware of this and looking at these provisions as they relate to them.
Absolutely, I would say you need to do a calculation either yourself or have a professional do it that you work with to determine that.
Okay.
In 2011, Mike, the medical loss ratio reporting requirement kicks in, and this is going to be applicable to insurance companies or possibly self-funded plans / employers. And that is that they are going to be required to spend at least 85% of their premium on medical care or quality improvement measures. That's going to be 85% in the large group market, which is defined as 50 or above employees, and 80% for the small group or individual market, which is under 50 employees. Okay. In 2011, we have a provision for the FSA, Flexible Spending Account Plan, which is going to take the penalty for unauthorized withdrawal from the plan from the current 10% up to 20%. And that is, you know, as you know, the Flexible Spending Account Plan allowed employees to, on a pre-tax basis, fund any unreimbursed medical, dental, or vision expenses that they might have from their insurance plans. And the penalty in the past has been 10% if you took it out and did something else with it.